I would now like to hand the floor to Ms. Pushpamani. Thank you, and over to you, ma'am.
Thank you, Neerav. Good evening, everyone. I welcome you all to the Q4 and FY21 earnings call of Renaissance Global Limited. We have with us Mr. Sumit Shah, Chairman, and Mr. Hitesh Shah, Managing Director. The discussion today may include some forward-looking statements and must be reviewed and considered in conjunction with the risks in the industry in general and our business in particular. During the Q&A session, I request all the participants to limit their questions to 2 per participant and join the queue again for a follow-up question. Now, without taking much time, I will hand over the floor to Mr. Sumit Shah for opening remarks. Thank you, and over to you, sir.
Yes, hi. Good evening, everyone. On behalf of Renaissance Global, I extend a warm welcome to everyone to this earnings conference call. I hope that every one of you and your families are staying safe and healthy. There's a sense of optimism with the vaccine rollout in the developed markets that comprise a large majority of our sales. We sincerely hope that the vaccine program accelerates in India as well as we go through this difficult time. Our strategy is to grow our business through licensed brands and our own brands globally. We plan to scale this division through distribution through our retail partners and direct-to-consumer. Due to the structural shift within the jewelry industry towards brands, we see a decade-long opportunity for growth for this division. We are also investing in our own brands, Jewel Lily and Made For You, to create value. We see brands as a means of differentiation in a very large global opportunity. We believe that the branded division will help improve our operating margins meaningfully over the years to come. We plan to invest in this division, generating meaningful cash flow and growth for our shareholders. In the last quarter, branded jewelry accounted for 23% of our total studded jewelry revenue. Our strategy is to continue to grow the share of this business. The company is focused on branded jewelry through our exclusive licensing arrangements with Disney, Hallmark, and our own brands. There are meaningful and significant discussions that are ongoing for new licenses that would support our growth for years to come. We will announce them at an appropriate time. We're delighted to announce our partnership with the second largest Chinese jewelry retailer, Lao Feng Jiang, LFX, for the Chinese market with the introduction of our highly successful Enchanted Disney Fine Jewelry collection. We have commenced operations in China by shipping our first order to LFX. Renaissance has planned an omni-channel approach for the Chinese market. We are very excited about the growth of our direct-to-consumer business. E-commerce adoption that accelerated during COVID provides long-term momentum for this division. Our direct-to-consumer business through our newly launched websites has shown robust growth during the year. Our Q4/21 direct-to-consumer revenues were 23 crores with an EBITDA margin of 19%. Based on our estimate of the quarter's contribution to annual sales, we are at an annual run rate of 115 crores. We expect the direct-to-consumer business margins to improve going forward to the 20 to 22% range. This is a 115 crore direct-to-consumer business built from zero in a matter of 15 months. We started our first direct-to-consumer website in February of 2020. In May 2021, we launched our 6th direct-to-consumer website for Hallmark Diamonds. To summarize, this is a very exciting time at Renaissance Global. I have never been more optimistic about the opportunity we see in front of us. The branded division and the direct-to-consumer division have increased our addressable market and margin profile as a company. We look forward to executing to this plan in the years ahead. Now I'd like to turn the call over to Mr. Hitesh Shah to discuss our financial performance.
Thank you, Sumit. Good evening, everyone. The company during Q4 of FY21 reported a total income of rupees 584 crores against rupees 453 crores during the corresponding quarter of the last financial year. That is a growth of 29% year-over-year. Our EBITDA grew by 32% to rupees 34 crores, while our profit after tax stands at rupees 16 crores, growing by 66% year-over-year. For the full year FY21, our total income is down 18% at rupees 2,048 crores versus rupees 2,510 crores last year. The FY21 EBITDA stands at rupees 116 crores versus 171 crores last year, a decline of 32%. Our profit after tax before discontinued operations stands at rupees 46 crores against a PAT of rupees 92 crores in the last year, down around 50%. We expect profit after tax for FY22 to grow between 18 to 22% over our FY20 profit after tax and more than 100% as compared to FY21 PAT. The company has managed to lower its net debt to equity levels to 0.29 in March 2021 from 0.52 as on March 2020. Cash and bank balances and current investments as on 31st March 2021 are at rupees 245 crores. The company's FY21 return on equity stands at 6%, which is due to the impact of COVID-19. It was 13.5% for the year ended 31st March 2020. Our long-term goal is return on equity greater than 15% and to be at zero net debt over the next 3 years. In terms of geographic distribution of sales in Q4 FY21, USA contributed around 49% to overall revenues, with 35% coming in from the Middle East. For the full year FY21, the breakup was US 59% and Middle East 27%. In terms of product category, studded jewelry contributed 66% to the overall revenue during the quarter, with the balance contribution coming in from the plain gold jewelry segment. For the full year, studded jewelry contributed 77% to the overall revenues. Thank you very much for your kind attention. Now the floor is open for Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use answer while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Sudhir Seha from Right Time Consultancy. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a good set of numbers, sir, and very strong guidance of 18 to 20% growth in from the FY20 level base. So congrats for that, sir. Hello, am I audible?
Yes, you are, sir. Please proceed.
Sir, my question is from where this optimism is coming from? Because still world is under kind of COVID impact. Of course, the developed countries have come out of it slowly. But I just want to know the demand outlook for the current quarter as well as current year. Has any effect of COVID is still there? And my second question is, how is the response in China for our Disney Fine Jewelry? Just we have launched over there. So these are the two questions, sir.
Thank you. Thank you for your questions. So I'll start with the first question on source of optimism. So in general, what we've seen during COVID is that as people have been unable to travel, the spending on goods has probably increased, and there has been a disproportionate increase of share for certain product categories. In the US and in Europe, there has been an increase in wallet share for our category, in our opinion. And the current momentum that we see with our retailers as we monitor sales on a weekly basis, as well as our direct-to-consumer websites, we are currently seeing strong momentum to our sales numbers, which gives us optimism for the year ahead. However, the world is still dealing with uncertainty due to COVID, and if there is any meaningful or significant lockdowns in the Western markets during the course of this year, our guidance may have to change. But currently, based on the vaccine rollout as well as the momentum that we're seeing with our customers, we feel reasonably confident for our outlook. And in terms of China, it's a little early to tell because we actually shipped only a few weeks ago. So I think this product is still getting placed in stores, and the retailer is beginning the marketing program. So I think we will be able to give you a lot better visibility on the next earnings call. It's a little bit early to tell on the China front.
And sir, one more question is, will that growth in the D2C segment and our own branded jewelry's growth, will that help our margin for the year going up significantly in FY22?
Yeah. That's right, sir. I think that the branded division and the D2C segment is definitely margin accretive and will help increase margins in the current year.
Thank you, sir, and thanks for the opportunity, and all the best, sir.
Thank you.
Thank you. I request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Mihir Desai from Desai Investments. Please go ahead.
Thank you for the opportunity, sir. My first question would be around, sir, I just wanted a view, if we see our H2 revenue mix, then the customer brands, the business from customer brands and plain gold has increased decent or say a robust number. But I just wanted to understand, sir, what is your outlook for our branded jewelry and direct-to-customer jewelry, because the EBITDA margin over there is quite lucrative compared to other business.
Sure. So, we think that the branded jewelry segment as well as the direct-to-consumer business will definitely grow faster than company average. And that's where we see a lot of customer interest in. So, the focus of the company as well as the entire management team is to grow the share of these 2 divisions. And we expect in the current year both the branded as well as the direct-to-consumer business to grow meaningfully faster than the company average.
Okay, so that will also kick in our EBITDA margin going forward.
That's right, sir.
Okay, understood. Now, sir, coming to a question on free cash flow, sir. So, if we see the free cash has been, significantly improved from from FY17. If we compare to now, it has been a positive cash flow. And going forward, do we expect this cash flow to sustain? Because do we see some investing activities happening over here, or how should we look at it?
So I would say that there is not any meaningful capital expenditure planned going forward. So we would expect to see healthy cash flow generation for the company. And because of that confidence, we've also announced our dividend policy going forward, where we'll be paying out between 15 and 25% of the consolidated profits of the company to shareholders. So I would say that we expect working capital cycle to remain stable or improve gradually as the direct-to-consumer business becomes more important because that has a better working capital cycle. And since our business is working capital intensive, which really is the main driver of cash flow generation, we expect free cash flow generation to be relatively healthy going forward.
Understood. So for further questions, I'll join the queue.
Thank you.
Yeah. Thank you. The next question is from the line of Geeta Mehta from LIC Securities. Please go ahead.
Hello. Yeah, so my question is regarding the gold price volatility. I wanted to understand that as gold prices are quite volatile, due to which there are inventory gains and losses. So how do you mitigate impact of such volatile prices, and what is the fluctuation impact on the bottom line?
Sure. Hitesh, you want to take that?
Yeah, so we pretty much get purchase orders from customers based on the market rate of gold, and we hedge the requirement in the futures market as per the orders, and reverse the hedge when the deliveries of gold is taken. So pretty much we do not have any significant impact on account of gold price fluctuations, or even the inventory held by us is pretty much on a loan basis from the bullion dealers or the banks. So essentially there would not even be any significant inventory gains or losses.
Okay. And my other question is that as I can see, your employee expenses have fallen down by 23% year on year during this quarter and 27% in the full year. So what are the reasons for such big reductions?
So I think during COVID, there we did sort of rationalize our workforce and look at what is required on an ongoing basis. So I think that there is we did take some pay cuts across the employee base, and there was some rationalization of workforce. So I would say a combination of these two factors has resulted in employee cost reduction.
Okay, fair enough. Thank you. That's all from my side.
Thank you. The next question is from the line of Kirtik Ghosh from Sequent Investments. Please go ahead.
Good evening, sir, and thank you for taking my question. You have guided for an ROE target of 15%. Could you give some color as to what are you doing to achieve the same, and when do you expect to achieve this target? Also, my second question is, other financial assets has increased sharply during the year, and what are these assets and why such a sharp rise? Thank you.
Thank you for your question. So in terms of return on equity, our expectation would be that we should be higher than 15% in the course of the next 2 to 3 years. And then your question of investments, I think most of the investments are either cash or short-term investments in liquid funds. So I think there has been working capital rationalization due to which we've generated significant amount of free cash flow, which has led to an increase in financial assets. All of them are either cash or short-term investments in liquid funds.
Okay, thank you. That's all from my side.
Thank you. The next question is from the line of Rajesh Kumar from Capital Portfolio Advisors. Please go ahead.
Good afternoon, sir. Thank you for taking my time to take my question. So my first question is regarding the US. What is your position of US market in terms of the sales and stores open? Are you seeing some traction in sales there? So because we know that US has been one of the worst affected markets initially during the COVID time. So as vaccination has progressed, are you seeing some traction from that front?
Yeah, thanks for your question. So yes, I think US is our largest market in terms of revenue share, and I think US has been very aggressive with the vaccine rollout, due to which there is I would say that all of our customer stores are fully opened and probably transacting at higher than pre-COVID levels. So I would say that in the US there has been significant return to normalcy to people visiting stores or buying online. And I think one of the benefits that we've seen during COVID is digital adoption, whereby customers have gotten accustomed to buying online. So even when we distribute through our retail partners, we are seeing a greater percentage of their sales come through online channels as compared to pre-pandemic.
Okay. So my next question is, during the full year, your EBITDA margin has fallen to 5.6% versus 6.8% in the previous year. So what could be the possible reasons to explain the same? Because as you explained earlier, you have reduced the employee cost. So still the EBITDA margins have fallen. And if you can also help us by giving some color on what could be the possible EBITDA margin going forward in the financial year 22 and FY23, and what could be the long-term EBITDA margin you have in the mind, so once things normalize, what is the trajectory you are looking at, which could be the stable kind of EBITDA margin which you would be aiming for? So I'd be happy to share if you like, if you can give some guidance on that.
So I think, for the past year, obviously the impact on the EBITDA margins has largely been on impact of COVID. I think in the Q1 of the financial year, largely our manufacturing units were completely shut down, and we had significant losses in Q1. Q2 and Q3 saw some normalcy returning, but we were still trending below year-over-year sales numbers. So largely the reduction in EBITDA margins has been due to operating deleverage due to the shutdown in Q1 and lower sales numbers in Q2 and Q3. We at this point, based on the information that we have available, see a lot of the operating deleverage behind us, and we would definitely see meaningful improvement in operating margins going forward. I think at this point, disclosing or discussing long-term EBITDA margins would be a little bit difficult because it depends on the growth of the higher margin divisions as they play out over the course of the next few years. But our endeavor as a company would be to meaningfully increase EBITDA margins over FY20 numbers going forward.
So I'm not looking at an absolute range. I know the situation is quite volatile. If you can just give some kind of color in the sense, like if the COVID situation goes away, things are normal, then what could be the normal range, a broad range, sir? Not looking at some specific number to hold the management responsible for that. What could be a normal operating range for a business which is at a stable end?
Yeah, so I think that in our presentation we've given EBITDA margins by division for 7% for our customer brands, about 12% and 20% kind of range. So I think that that's essentially what you're looking at for the diamond jewelry segment. The plain gold jewelry business is largely passed through, which actually drags down our overall EBITDA margins. I would say that our diamond jewelry EBITDA margins are in the 10 to 12% range, 8 to 10% range today. I would say that we would see meaningful improvement in our diamond jewelry EBITDA margins. That's what we would sort of focus on broadly, and that's where the highest scope is for improvement in margins.
Thank you, sir. I will rejoin the call. Thank you, sir.
Thank you. The next question is from the line of Vaibhav Kacholia from VK Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. I wanted to know what could be, sir, over a long-term period, like 5 years, maybe the size of the D2C and the branded jewelry market, especially the D2C market.
Sure. So, I would say, the addressable market obviously is very large, and I think that a lot of the growth will depend on us executing to this large opportunity set. We're fortunate to have arrangements with some of the most loved brands globally, Disney as well as to a lesser extent Hallmark. We are currently in discussions for significant additional meaningful licenses in the future. So I think a lot of it will depend on how we execute to the plan. Just to give you a perspective, I think broadly, the U.S. diamond jewelry industry is somewhere in the region of $40 billion. I think the largest e-commerce player today would be about 1.3 to 1.5 billion, which is Signet, and there is quite a few players in the direct-to-consumer space who would be in the $200 to $700 million range. So I would say that the opportunity is large. Obviously, for us, it's a one-year-old business, and we're focusing on this business to grow it. Would be difficult to sort of 5 years out and where it could be, but the opportunity set and the addressable market is relatively large, and we're laser focused on growing this part of our business.
Got that. So our target would be to reach $100 million or something like that. And within that, I wanted to know, how do we sell this online, sir? Is it only through our own site? If it is only our own site, how are they publicized? And secondly, do we also sell through marketplaces like Amazon and Etsy and all these kind of sites?
Yeah. So about 90% of the sales are through our own websites, and about 10% is through marketplaces. And the advertising is generally through paid search on Google, as well as Google Shopping and on various social media platforms. We also have a PR agency that sort of works on talking about product placement as well as getting free traffic to our website. So it's a combination of social media, Google search, shopping, and various other means. So just to give you a perspective, we're currently investing between 20 and 30% of sales on advertising. So that sort of gives you the scope of what we're spending on advertising as a percentage of the direct-to-consumer sales in order to grow that business.
Okay, and the marketplaces ratio, can it improve? And Signet and all these other companies, do they do similar numbers, percentages through marketplaces, or is it any different?
So I would say that the retailers such as Signet, generally tend to sell through their own channels and not so much to the marketplaces. We've not been as focused on growing the marketplaces segment because our own website is more strategic from two aspects. One, it's more profitable, and two is we own the customer, which means that we have the ability to sell the customer again. We have data on who the customer is and have the ability to sell to the customer again. So our preference would be to grow share of sales on our website because longer term customer acquisition costs will decline meaningfully due to this.
Got that. And what is the current customer acquisition cost per customer, sir?
Yeah, so as I mentioned, it's between 20 and 30% of sales depending on the website.
Okay, got that. Thank you so much.
Thank you. The next question is from the line of Disha Shah from Global Securities Finance. Please go ahead.
Yeah. Thanks for the opportunity. Sir, I just wanted to know that our Q4 sales and profits are down significantly sequentially. So can you share the reason for the same?
Yeah, so Disha, I think the way to look at it would be annually because Q3 is a very important quarter for us because of seasonality and due to Christmas and Thanksgiving, since we're primarily selling in the US and in Europe. A large majority of the diamond jewelry sales happen for the Thanksgiving to Christmas time period, and I think historically this would be in line with our trend of how our sales tend to be. And this would be true of any consumer products that are sold in US and Europe.
Okay. And my second question is regarding that what impact our business has seen due to the compulsory hallmarking.
So again, we are not operating meaningfully in India. We don't have any sort of we have very limited sales exposure in India. In the US or in Europe, there has been no significant change in regulation in the past year.
Okay, thank you. That's it from my side.
Thank you. Next question is from the line of Shweta Shah from Samarthya Capital Private Limited. Please go ahead.
Thanks for the opportunity. I have a couple of questions. So my first question is on the advertisement cost, which has increased sharply during the quarter and year. So can you explain the reason for the same and also give some guidance on advertisement cost for the year FY22?
Sure. So, we did not have a direct-to-consumer business in the last financial year. It was all of our jewelry was sold through our retail distribution partners. As I mentioned to earlier on the call, we are currently spending between 20 and 30% of the direct-to-consumer sales on advertising, and we plan to continue to do that as we still see an opportunity to make 20% EBITDA margins on direct-to-consumer after making that kind of investment on advertising. So that would be a good guide in terms of advertising expenses between 20 and 30% of direct-to-consumer sales.
Okay. And my second question is with regards to the enchanted fine jewelry collection, which is expanding into China. So what is the visibility and growth outlook for this segment?
Yeah, so I think that, since we just shipped under a month ago, I think that, currently it's a test program happening in a couple of hundred stores. I think a lot will depend on the success of this test program and how it does. I think that, we'll be able to give a lot more visibility on this in the next quarter's earnings call, because currently we don't have too much information.
Okay. That's it from my side. I'll come back in with you.
Thank you. The next question is from the line of Nikhil Jain, an individual investor. Please go ahead.
Yeah, thank you. Thank you for the opportunity. I just wanted to understand, so all the work that we actually do for manufacturing of our items, is it done in India, or is it like part of it is done overseas also?
Yeah. So the gold division, all of the manufacturing happens in the Middle East. So the gold jewelry is actually made in Dubai and sold in the Middle East. For the diamond jewelry division, I would say that about 80 to 90% of the manufacturing happens in India, and the rest is outsourced to China and Thailand.
Okay. And thank you. My second question is that, let's say, what is the geographical split for the diamond jewelry? So the gold jewelry, you said that we do it in Dubai and sell it in the Middle East. But for the diamond jewelry, what is the largest? I think the largest proportion is coming from the US, but what may be the split for some other countries or continents, let's say, for example, Europe?
Yeah. So if you remove 30% of the sales, the balance is split between 90-10 between US and rest of the world. I mean, so there's I think 10% in rest of the world, which is all diamond jewelry. So we only sell gold jewelry in the Middle East, and the rest is US and Europe. We don't sell any plain gold jewelry in the US or Europe.
Okay. Yeah, sure. So one more question that I had was that we have mentioned that we are now having 6 websites for 6 different collections that we are having, and I think we are promoting them on the strength of their individual brand names and other things. Have you, let's say, kind of considered, or do you think it may be useful to have an umbrella kind of a brand against which there are, let's say, these 6 or maybe even more licenses coming in? So there is umbrella brand on RGL, and then there is all of these brands which are available. Right. So
yeah,
again,
so that's a great insight, and that's something that we've been debating and discussing internally as well. So that's definitely something that would be a worthwhile exercise for us to do. I think that currently we are focused on we have one more website to launch, which is Disney Jewels, which is all of the non-princess iconic characters that we plan to launch during the course of this year. I think once we're done with that, there definitely has been discussions about an umbrella website, but we haven't really made any firm decision on that. But I think you bring up a good point, and that's a very meaningful discussion for us to have and something to execute in the future.
Sure. Thank you. That's all from my side at this point. Thank you.
Thank you very much. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Rajesh Kumar from Capital Portfolio Advisors. Please go ahead.
Thank you, sir, for taking my question. Sir, during the last year in financial year 21, so what has been the capex and what are your capex plans for FY22 and FY23? And also wanted to know, is this business capital intensive, or what is the kind of the terms you can get, like business can expand with a small incremental capex? If you can throw some color to that, that will help a lot.
Yeah. Hitesh, you have the capital expenditure numbers, or should we get back to?
No, I don't have it at hand, but it is significantly lower than even the depreciation on fixed assets. It's probably a couple of crore rupees, but I do not have it on hand.
And so your plans in the future, do you for growth, what is the kind of the growth outlook you are looking at? And to meet those plans, what kind of the capex will be required to achieve that?
So I think we're moving towards a business where either the licensed brands or the direct-to-consumer business will become more important. And we feel that currently we have enough manufacturing capacity for the next 2 to 3 years to meet our needs. We don't envisage any significant fixed asset investments. And there is also the opportunity to outsource some of the production to outside vendors. So we don't anticipate any significant meaningful investments in fixed assets. It's the business is really a working capital intensive business, along with a lot of the focus shifting on brand creation and marketing. So fixed assets going forward will not be very meaningful.
Okay, sir. So my next question is that this year, unfortunately, COVID has impacted a lot of employees in the organization. So if you can give some information what has been the impact on COVID to your employees, and unfortunately, has been there any casualty among the key employees, that will be helpful for us to know for this.
Yeah. So Hitesh, you want to answer that?
Yeah. So I mean, just as everywhere else, quite a few of our employees too have been affected by COVID, and till date, we've unfortunately lost 2 employees due to COVID. From an employee base of around, including contractual employees, around 3,000 people, and thankfully everybody else has recovered. That's the number still now.
Okay, that's great, sir. And sir, are all your stores, and what is your impact of COVID in terms of the business? Is the office open, or when it is planned to be open or something like that?
So our manufacturing is completely open as it's a permitted industry. But the office area, people are typically working from home. Some of them work from office partially, but it's predominantly work from home for the office area. And I think we'll bring them back to the workplace as and when things become better, and once the vaccinations are also kick in. So in fact, as a company, we are this week itself we have an employee vaccination program. So pretty much we're getting all our employees vaccinated this week.
That's great, sir. Just a last question, sir. So thank you for taking time also. So on the debt front, sir, if I could know what is your cash flow generation plans and repayment plan of the debt, and if you are aiming to become debt free and by when, that will help a lot, because one of the possible reasons why the stocks of the companies like yours have been not getting the true valuation is the concerns on the debt on many of the companies in the similar sector. which may not be the true for you, but like it becomes somewhat of hindrance in the jewelry sector. So if you can give a guidance or a comfort, like what your plans of the debt repayment is, I think that will help a lot.
Yeah. So, we've brought down our net debt number from, FY19 when we had done the acquisition of JGems. I think our net debt number was 500 crores and a, debt equity ratio of 0.76. We're now down to 240 crores of net debt with 842 crores of capital. So our debt equity ratio is 0.29. And I think as Hitesh mentioned in his opening remarks, over the next 3 years we plan to be at net debt zero. That's really the goal that we're working towards. Hopefully, within 3 years we get there.
Thank you, sir, for the clarity in that. Thanks a lot.
Thank you. The next question is from the line of Mihir Desai from Desai Investments. Please go ahead.
Thank you for the opportunity. So, one question on accounting front. So, if we see on our consolidated balance sheet, the borrowings number, the long-term borrowings have increased. Like, if I see on March 20, it was 1.8 million, and now it is 288.6 million. So, I know this number is not big, but just wanted to know that what is the component which is reflecting here, sir?
So, a part of the component is actually the COVID loans that I think we have taken both in the US and in India. And since they are not in the nature of short-term working capital, but a bit more longer-term in nature, I mean, that's why it's showing up in a long-term loan.
Okay. Understood.
This was availed like in the quarter one of 2021. So it was availed in June of last year, pretty much.
Okay.
I think the U.S. government's payroll protection program, as well as some COVID loans here in India, which were given out right at the beginning of the pandemic. We don't have clarity around the U.S. Paycheck Protection Program, whether the loans have to be repaid or not. So they show up as sort of, and we don't know the repayment schedule yet. So which is why it shows up as long-term instead of short-term.
Understood, sir. So now, just final few questions on macro front, sir. Sir, as we see the gold prices are strengthening, so will this affect our business or demand? How do you see this, sir?
So we currently don't see too significant impact on demand. I think what we've seen historically on the gold division, when there is a lot of volatility, there is some impact on demand. Once it stabilizes at a certain level, demand comes back. On diamond jewelry, gold price is not a very meaningful factor to the overall cost. And we haven't seen in the data any impact on demand due to gold prices.
Okay. Understood. So nothing to worry about. Currently, there is nothing to be worried about the demand front. And sir, one number which I forgot was, sir, can you please give the number of online sales which happened in FY21, sir?
We've sort of the number of orders or the...
Sir, any ballpark of revenue is also fine.
So on our presentation, which we've sort of laid out, I mean we've disclosed the numbers. I think we did about 60 crores of revenue, and the average order value would be around $200. So I think if you want to calculate the number of units, you can. But yeah, so I think we did about 60 crores of revenue in the last year, and currently, as we've sort of disclosed, it's currently trending at 115 crore run rate.
Okay. Sure. So that has increased significantly. And sir, now my last question would be on a macro front. Like, from your point of view, sir, what excites you in terms of business and in terms of your plans for the business say, from next fiscal or coming fiscal and going forward in the future. So I just wanted to know, sir, now, like, what excites you for the business, going forward?
Yeah, so I think we see a huge structural opportunity within the jewelry space to actually make branded jewelry a much larger part of the overall space. I think, we've seen this trend happen over the last 10 years where once De Beers stopped advertising diamond jewelry, I think individual storytelling and brands became more important. And we're seeing that trend continue. And we see that that's a long-term trend for growth within our industry. And I think COVID has accelerated the shift to online. So if I were to tell you what does sort of our company's growth plan looks like, I mean, we've really got sort of, two legs of growth. One is more of our own brands and licensed brands, and two is, the direct-to-consumer space direct-to-consumer division becoming a much larger part of our overall business, which will, help improve the margin profile, working capital cycle, and, in general, the financials of the company.
Correct. Understood, sir. So that's all from my end. Thank you for answering all the questions.
Thank you.
Thank you. The next question is from the line of Chirag from Budrani Finance Limited. Please go ahead.
Yeah, good evening, sir. I wanted to get a sense, the top line has gone down for FY21, but yet the working capital has gone up. So can you explain what are the reasons for the same?
Yeah, so I think that, what's happened is largely the quantum of the working capital has largely remained the same because working capital did not shrink meaningfully with the sales numbers. So I would say that, the working capital days look higher. However, our receivables are a little bit lower than last year. Our inventory numbers are slightly higher as we've made investments in, the direct-to-consumer business. So, the quantum of working capital having remained the same, I think the working capital days looks a little bit higher because of deleverage from the first 2 quarters.
So is it because, see, what I understand is if you have a higher component of whole business, generally the working capital days are higher. Now that, we are going into online sales, wouldn't we see a lower number of days going ahead?
Yeah, so I would expect the working capital as we grow in absolute terms to remain similar, the quantum. So, currently we have about 850 crores of inventory. I don't see the inventory number or the receivable number grow meaningfully as sales grow. So the number of days of working capital will go down. And you're absolutely right that as the direct to consumer business becomes more meaningful over the next couple of years, we should see an improvement in the working capital cycle in terms of number of days employed.
What is your ballpark range where you want to get it? Around 120 days, or have you got any target?
We don't manage the business in terms of number of days, because I think it depends on sort of the mix of wholesale to retail, and I think we manage each business individually based on what's optimum for that business and where the mix lands up. So, we're really looking to optimize total cash flow, and our view is that total cash flow should be equal to higher than profits of the company. In terms of number of days, we don't have a specific target in mind because it all depends on the mix of the 4 divisions and what each division contributes to the sales, because the gold division has the lowest working capital cycle, and the customer brands probably customer brands and D2C has the second highest, and so it depends on the mix of the various divisions that play out during the course of the year.
And sir, one thing on the discontinued operation, do we see this in FY22, and what is this pertaining to?
Hitesh, you want to take that?
Yeah, so it pertains to our Bangladesh operations, which we seized 2-3 years ago, and I think this is pretty much the end of it. We do not think there'll be like any significant impact going forward. I mean, only residual value that we carry on the balance sheet is like around 40-50 lakh rupees of that investment.
Okay, thank you, sir.
Thank you. The next question is from the line of Vaibhav Kacholia from VK Capital. Please go ahead.
Yeah, so I wanted to know what are the key challenges which will define our success in the D2C business? Like, what are the main factors which determine how much we sell and the success of that business?
So, Vaibhav, I think the main driver of growth really is having a profitable customer acquisition cost which makes sense for the business, right? Because I think that one has to figure out what the available margin is and what you're willing to invest in growing the direct-to-consumer business. So the opportunity set is extremely large. The brands that we currently have are very meaningful and well-loved. We've obviously displayed the ability to create good product because we sell a significantly higher volume through wholesale channels. So the key challenge now for us as a company is to figure out how we can acquire the customer, how we can minimize customer acquisition cost as a percentage of sales and do it efficiently so that we can continue to acquire customers and users in order to grow the business. So I would say that challenge number one really is customer acquisition, and number two is ensuring that the brand resonates with the consumer.
Okay. So at this early stage, how is it that we are still making 20% kind of EBITDA margins? Shouldn't there be a startup cost of this customer acquisition and online branding and all that kind of stuff?
So the advantage that we have is that the brands are known because we are distributing them through other retailers, because of which we are seeing more profitability on the licensed brands as compared to our own brands. You are right that there is an investment cost for our own brand. So we have two brands, Jewelry as well as Made For You, where we are seeing customer acquisition costs being meaningfully higher than the licensed brands.
Okay, that's very interesting. And so what kind of domain expertise are we trying to create? Since you say that like the customer acquisition part is one key part of the success, so what expertise and what right to win do we have in that space, and what are we trying to create there?
Yeah, so I think that clearly in order to win in this space, we've really got to have our marketing on the ball and understand the consumer mindset. So we have a reasonably large marketing team in the US who understands what the customer is looking for, and supported by a digital team with significant experience. So really, our core competence to build the direct-to-consumer business is going to be around marketing and brand building as well as digital marketing, which allows us to grow this share of the business.
Got that. And can't the same thing be done in India?
So I think there are some parts which are already being done in India, and there are some parts being done in the US, depending on what is required.
Right. No, I was asking, can't we sell to customers in India?
So currently, I think that we don't have a distribution platform in India. We've made an investment in 3 stores now in a brand called Iraswa. We don't have a distribution platform in India, and I think that Disney is not, especially the princess characters are not as well known in the adult market. We're not selling children's jewelry. We're selling adult princess jewelry. So through our limited experience, we've not had much success in India. That's something that we, for our licensed brands division, may do in the future, but currently we don't anticipate any meaningful revenue coming from India for these licensed brands.
Okay. And getting these licenses would be a normal process, right? So everyone, any vendor can get these licenses. It's a normal system, right? For these Disney and all. Is there any competitive advantage there?
So we have an exclusive license for branded for fine jewelry.
I mean, no one else can do Disney character jewelry?
On the princess IP for fine jewelry space, it's us and Pandora who have the license, and it's not available to anyone else.
Okay, got that. Right. Thank you so much.
Thank you. The next question is from the line of Ashish Shah from Business Match. Please go ahead. Ashish Shah, may I request you to unmute your line from your side and go ahead with your question?
Yeah, hello Sumit. Hello Hitesh. Congratulations, on a very, very good set of numbers. Sumit, I think, great going. I think what you just created, in 12 months time in DTC, to create a 100 crore portfolio with a 20% margin. So great going. I just had one question to that, Sumit. Any thoughts on, now that you've got, these consumers coming to our website, what are you doing to, convert them into repeat customers?
Yeah. So I think that what we're currently in the process of doing is we've just signed an agreement with Salesforce whereby we're implementing their solution for all of our websites, and I think that using a lot of the tools that they have, AI, email marketing, as well as targeting customers through various channels. We believe that will be an important tool for us to be able to mind the customer, know what they want, and present the right product to them. So we're currently in the process of implementing Salesforce's sales and service solution onto our platform, and we expect to go live in the next 90 days. I think that should be sort of a meaningful step forward for us to be able to mind the customers better and to be able to lower our customer acquisition costs even further.
Okay, that's helpful. And just wondering, Sumit, when you look at the products, the SKUs which are available on our website, versus the same which is available to some of the other US retailers, how different are these SKUs and especially the pricing?
Yeah, so I would say that we try to protect all the retail partners through who we sell by giving exclusivity to most of the retailers. So we definitely do not sell the same product on our website as our retail partners would do. This creates some differentiation. Obviously there is overlap due to the IP being what it is, but we definitely try to protect our channel partners by giving them differentiated SKUs from what we sell on our website.
Okay, that's quite helpful. And lastly, Sumit, now that you're entering China as a market, early thoughts, how different do you have to position yourself in terms of the product and pricing? Does the product have the same mix of studded jewelry and gold mix, or is it more platinum, or when you go to China market?
So I would say that the product for China would be obviously styled a little bit differently because it's a lot more simpler, smaller styling in better quality. So China is primarily 18 karat with better quality of diamonds than what is generally sold in the US. But we plan to target only the studded jewelry market and not plain gold jewelry in China, as it's significantly higher margin.
Sure. Just one last thing, Sumit. Since you are now talking to some other people in terms of your licensed brands, would they also exhibit similar return on capital matrix, in the sense would they also be as profitable as your existing license contracts?
I think it's a slightly longer term period, longer term time frame that we're talking about. Any of the new brand owners that we're talking about for licensing opportunities, but we see that there is significant and meaningful other licenses that we can get and we could tie up with in order to create opportunities for future growth. I think it will be a longer term period to get to the levels of profitability that we have with slightly more established brands, but we see opportunity for a lot more licenses that can drive growth in the future.
Okay, thank you very much, Sumit, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Shweta Shah from Samarthya Capital Private Limited. Please go ahead.
Thanks for the opportunity again. So my question is with regard to the recent launch of your 6 direct-to-consumer websites for Hallmark Diamonds. So I wanted to know what is your strategy on expansion of direct-to-consumer websites for the Hallmark Diamonds?
Yeah, so on the direct to consumer websites, we've sort of got Star Wars, Enchanted, and our own brands and Hallmark. I think the strategy remains consistent. That very focused and targeted customer acquisition in terms of finding the audience that is most meaningful for the brand. And since there is a market that already exists due to our distribution through retail partners, we plan to leverage some of the brand recognition that has been built over the years as we've sold this through our retail partners in order to profitably grow the Hallmark Diamond brand as well.
Okay, that was helpful. That's it from my side.
Thank you.
Thank you very much. As there are no further questions, I will now hand the conference over to the management for closing comments.
Yeah, thank you everyone for joining us on the Q4 '21 earnings conference call. Just to summarize, I think we are seeing strong momentum across all of our geographies that we operate in, and we're very excited about the year ahead. Look forward to seeing all of you in the next earnings conference call. Thank you.
Thank you.
Thank you very much. On behalf of Dickinson World and Renaissance Global Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.